Hello, everyone, and welcome to a Blue Ridge Associates webinar. Just so you are all aware, this is going to be recorded and shared with anyone who registered for this event. And please note that anything you hear today will not be considered legal or tax advice. If you have any questions of that nature, please consult an attorney or a tax professional. Uh, so, without further ado, allow me to introduce our speakers today. On the next slide, please. Ashton Ellis is a senior ESOP strategy consultant at Blue Ridge Associates, where she partners with business owners and plan fiduciaries to design and implement long-term strategies for employee stock ownership plans. With over 17 years of experience in retirement and employee benefits industry, Ashton specializes in repurchase obligations, forecasting, and the financial mechanics that drive successful ESOP outcomes. Working remotely, Ashton serves clients nationwide, offering strategic insight grounded in both technical knowledge and practical application. We've also got Kristen, who has over 17 years of experience in ESOP administration and consulting space. She is the director of ESOP consulting with Blue Ridge Associates. Kristen assists clients by reviewing the administration work and consulting on employee stock ownership plans and other qualified retirement plans, as well as consulting on repurchase obligation studies and feasibility compliance studies for new ESOP transactions. So with that, take it away, ladies.
Hello, everyone.
Right. So I'm just going to cover the learning objectives. Today, we'll be discussing the available levers to adjust the repurchase obligation to meet the company cash flow needs and company goals. And we'll look at those as a newer ESOP versus a more mature ESOP. So we'll go through the different repurchase methods, the different distribution policies that can impact repurchase obligation, tips to minimize capital constraints while balancing multiple objectives, and then provide insight on how you can provide sustainable ongoing retirement benefits. Why project repurchase obligation? So it allows you to project the future, the stream of future negative cash flows, provides a yearly estimate. So it helps you better anticipate cash needs and then plan for possible unanticipated events requiring cash. It can be used as a component of corporate financial projections, a basis to plan for adequate future cash needs. And it determines will current plan policies support companies' goals of plan benefits provided to ESOP participants. So it helps you have a better kind of roadblock, better plan for future cash needs so you don't get in a crunch if you have a high obligation in 1 year. And then as far as the life cycle of ESOPs, a newer ESOP typically recycles all of the shares right after the transaction for the first few years as the share price is still depressed from the transaction debt, because most companies can afford at that time to just recycle all of the shares for repurchase. And then as an ESOP matures and more shares are allocated, the repurchase obligation increases. Your share price starts recovering from the transaction debt. And that's when companies may look into different ways to manage the upcoming repurchase obligation to maintain sustainability and better manage the company cash flow and benefit levels. Projecting the repurchase obligation allows the company to get ahead of any large projected repurchase years. So you can make adjustments if you're projected in 5 years to have a large repurchase in one single year. By doing that projection in advance, you can better plan for and help make adjustments to the repurchase method or the distribution policy to determine how to get to the desired outcome. And so running different scenarios to see what options you can do to help mitigate possibly those high repurchase years to get your resulted outcome.
And so this is Kristen, and I'm going to talk a little bit about preparing a repurchase study. because a study is what's going to tell you what those projections are. Usually ours are over a 20-year period. Some of them would go out around 10 years. And so here we're first talking about some of the assumptions that are going to go into those studies to be able to get those projections out 20 years. So we're looking at the demographic assumptions for projecting turnover rates, your headcount growth for participants, so the people that actually meet the requirements to enter the plan, and your annual compensation increases. And so you can look at historical data, or your TPA has that information to kind of tell you what it has been, looking maybe the average of over the last 5 years. But then we have COVID in there, so you want to make sure, do the last 5-year averages make sense, or do you need to tweak those going forward? Or do you have projections that would allow you to use technology or other efficiencies, maybe where you're not needing to add as much headcount as you have in the past, or maybe you're projecting lower turnover rates than you've had in the past. So you want to revisit those and make sure that the future projections on those items make sense. And then the other main piece of it is the company value assumptions. And again, we're going out 20 years, so we know nobody has a crystal ball, but you usually have a 5-year financial projection that you're providing, at least the valuation firm and others, and using internally, that you can hone in on those first 5 years a lot closer, and then make some more general assumptions for those outer years. And then we're just talking about some of the data gathering that would go into that process, especially if your third-party administrator isn't the one that's performing the study. So they would need all plan information and history to be able to study. So going back to the stock value projection piece of it, it's best if you can start with enterprise value growth, and then if you use the full valuation report and kind of analyze the different things that they're using in the valuation report to get to your equity value, that really helps to see how your stock value is growing versus your enterprise value, especially if you have debt from the transaction, or other outside debt and warrants and SARs and other things that are playing into that, because they can be very different. And then how many shares you're going to have outstanding to get to your per share value each year. Then for the trust piece of it, for projecting if there's going to be any projected cash buildup within the ESOP trust itself, with contributions above and beyond the annual ESOP loan payments, or if you're a partial ESOP, or if you're needing to have S distributions above and beyond contributions, if there's any of those planned, the person completing the repurchase study would need to know those, as well as your current or planned distribution policy. So then once you get those two pieces, the demographic piece and the stock value projection piece, then you want to kind of look at those together and see how they align. Because if you said you were going to grow your stock value at 5%, and you're growing your head count at 4%, and your annual compensation increases were 3%, then you could be growing your eligible wages in total more than you are your stock value. And that can kind of exasperate over time and show that you're really showing that you're becoming less efficient, or you need to hire more people or pay them more to get the same revenues. So after you get those two separate pieces done, you do want to look back and make sure they work well when you align them together. So once you have all the assumptions in there, you're running the first scenario using those, then you would typically have a call with your advisor to go over those results, see if they have any red flags that initially pop up with what the results are showing. Some companies, depending on their size and how complex things may be, or even how comfortable they are projecting stock values. The valuation firm may be involved in the process to help with the stock value projections, or if you're doing a full sustainability study, they may be helping with a piece of that as well. And then you want to look at those assumptions again when it looks good on paper when you say the percentage growth and what assumptions to use for the study, and then when you see the results, it's like, well, this is growing, our eligible comp or head count is growing way faster than anticipated. It compounds too quickly over time, or maybe you were too conservative with your stock value growth projections. And for this purpose, you really want to know how much cash the company could really need to come up with to fund future repurchase obligations. So for this purpose, you don't want to be too conservative with that growth. And then you do want to have at least one other scenario, even if there weren't any necessarily red flags or changes that were recommended immediately. You usually want to have something to compare it to, just to see if you're on the right track and keeping doing what you're doing or using the assumptions that you had initially. Even if it's an up and down case scenario on the stock values, you do want to limit the changes that you're making between the scenarios to one key item so that you can see the impact of that change in the study results. But you do want to use your advisors and run additional scenarios. Having, there's the moderation is key in that too, because if you have too many scenarios, then you can get lost in some of those results and the changes being made, and maybe not even know where to go or what you decided to do when you look back to all those different scenarios.
Ashton,
And
before
then
you
benefit.
continue, I apologize. I just want to interject because I neglected to mention, if you have any questions, please use the Q&A feature. We will either try and answer them in the Q&A box, or if it's relevant to the discussion, I will bring it up to our speakers. Thank you so much. Go ahead, Ashton.
Yeah, thanks, James. Okay, so next we're going to be discussing the benefit level, and that's really going to drive your company goals and what how you want to operate the plan. So the ESOP benefit level is the value the participants receive from the ESOP on an annual basis. So this is looking at the annual allocation that the participants are receiving from the plan. And this is made up of value of shares released from loan payments. If you're still a leveraged ESOP and you're still making payments on that internal loan, any cash contributions, either to fund current year repurchase obligation, or if you're pre-funding or just putting in a set cash contribution each year for future year repurchase obligation. The value of stock contributions goes into that annual allocation for participants, and then the value of reallocated forfeitures. So this is commonly communicated as a percentage of eligible compensation if you want to kind of compare the benefits of your ESOP plan to like a standard 401k match or something like that. And the thing to keep in mind about benefit level is that the allocation that the participants are receiving is not equivalent to the contribution that the company is making into the plan each year. So the contribution level is the cash that's put in to either repurchase and recycle shares in a year, the dollar amount of the loan payment that goes into the plan each year to release shares from a releveraged ESOP, and then the loan payment that goes in to release those shares is not going to be equivalent to the value of those shares released. So typically earlier on in an ESOP, the company is contributing more cash to release a smaller dollar value of shares from that company loan, since that share price is depressed from that transaction debt. But once that external debt is paid off, then the future value of shares released, it typically exceeds the dollar value of the contribution that the company is making into the plan. So that's kind of shown here on this graph. The blue is the cash contribution that the company is making into the plan, The orange is the benefit, the annual allocation that the participants are receiving from the plan. So once that, probably right where those line meets is about the time that external debt is paid off. So the share price is rebounded and now the shares are worth more than the transaction loan price. And so as that share price increases, the value of the shares released regularly exceeds the debt payment. So this is where more mature ESOPs, once they release more shares from the loan, this is when they might want to look at doing a repurchase study to better control that benefit level, because it really can start to increase as that debt's paid off and the company is releasing the shares and then having to fund the possible recycling and repurchase of future shares. And then the average contribution level for mature ESOPs is typically, around 6 to 10%. It can always be higher. It can always be lower. Leveraged ESOPs have a higher contribution level typically because they still have the payment that they're making on that internal note. So that leveraged ESOPs tend to be making a little bit more of a contribution than non-leveraged ESOPs, but that's not, not every single case. That's just kind of it's something that we commonly see, but not always.
And just Ashton, just another note on that. We hear a lot of people talking and discussing and hearing at conferences and other places about targeting a benefit level. And that is very popular to do. But if you have a naturally high benefit level or your equity value to compensation ratio is really high, then it may be difficult to really target a lower benefit level than you have naturally, depending on your facts and circumstances, of course. But you may be jumping through a lot of hoops to try to meet those goals, whether it's trying to do things that would possibly help suppress the value, or excessive releveraging or other things that take a lot of coordination and can cause some red flags or audit risk to pop up. So just something to keep in mind when you're trying to target benefit levels. An ESOP benefit level is normally a lot higher once you become a little more mature of an ESOP than other companies are providing.
Hey, Kristen, a couple folks wanted for some clarification on 6 to 10% of what salaries or what specifically were you referring to?
Yes, when we're talking about percentages on contribution or benefit levels, we're looking at eligible compensation. Okay, I'm going to briefly discuss the 4 R's, not to be confused with a 4-letter word. So we're kind of assuming that you guys know the basics of each of these or have a basic idea of how each of them happen. So I'll go over this fairly quickly. Recycling is where you are selling shares from a terminated participant and keeping them within the trust, and they would go to the active participants in the plan. The shares stay the same, same shares outstanding at the end of the year. A redemption is where you technically have a stock distribution to the participant, and the company is funding the value of those shares, same value as they would receive with recycling, but then those shares are typically put into treasury and you have less shares outstanding overall. Releveraging is where you do step 1 with redeeming shares, but instead of them staying in treasury, you immediately enter into a new ESOP loan similar to the original transaction, where those shares, instead of being dumped into the hands of other participants all at once in the same year, are then spread over time, and as you're paying new ESOP loan payments annually and releasing shares. And reshuffling, otherwise known as segregation, is where you are taking terminated participant stock and cash position within the ESOP trust. So there's segregated cash that sits in the ESOP trust, and those shares would move similar to recycling to the active participants. So how do I know what I should be doing? Like we said, Ashton said a little bit ago, most of our newer ESOPs start off by recycling, and some plans do recycle forever. But it may make sense to change, and it depends on each company situation, what their goals are, what their benefit levels are, and if they're meeting compliance testing and things like that. So there could be, you may have a year where you have a big blip from retirements or when diversification kicks in or something like that. Or it could be a longer term issue. So it depends on each situation. And it just needs to be revisited over time. So you may not need to make a change right away, but a study will show you if there's a time within the period that it may make sense to change what you're doing. Ashton, if you can move, yeah. So this is just kind of showing some of the impacts of each of the four R's that we were talking about here. And you're recycling with either contributions or S distributions. So if you're needing to make S distributions above and beyond the maximum deductible contribution limits, which is the 25% of eligible wages for all qualified plans, then you may need to recharacterize some of that deposit as an S distribution. And depending on how many shares you have allocated to accounts, those are going to be allocated to people based on stock account balances. So that could be a good tool to use if it's a 1 or 2 year issue, but likely not long-term solution for going above that 25% limit, as it can cause a have and have not issue. And then if you're redeeming shares, you are going to impact the per share value because you have less shares outstanding overall and your denominator is reduced. So there's no dilution with that, but you do want to look at, if you're an S corporation, the 409p testing impact before you would redeem any shares. And then you also want to consider any warrants or any other synthetic equity and the impact to those as well. And then re-leveraging is similar to impact to the recycling.
Hey, Kristen. Some companies re-leverage every year, yet you mentioned that excessive re-leveraging might trigger a DOL audit. Could you elaborate?
I mean, there's just court cases that are out there, and there is some scrutiny against, re-leveraging and what's excessive and what you're really trying to do with it. So if you have, if your benefit levels are showing 100% of compensation as your benefit level, that's probably not a reasonable ongoing benefit. And so re-leveraging can be a good tool to help mitigate that and bring that down to a more reasonable benefit level and make it a more sustainable ESOP, for the foreseeable future, and have shares to allocate to your future new participants coming in. But if you're doing it for the wrong reasons, I think it can draw some red flags with that, especially I think if you're needing to include price protection, if you have a value drop with the re-leveraging. So it again is facts and circumstances for each company. And we do have clients that re-leverage every year, and that can help if they're all, smaller re-leverages. But there's also some cost to re-leveraging because it is typically like a transaction where you're needing a new stock value, and there's documentation and a lot of professionals involved in that process. So you just need to evaluate and see if it makes sense in your situation.
Great. Thank you so much.
Okay, so the next section is the distribution policy for your plan. Oh, sorry, Kristen, you got this one.
Okay. Yeah, so when your plan document does have language for how distributions can work, but this is usually just the general guidelines or the guide rails for you to stay within. So this is telling you what you can do, at the maximum. Some plan documents, and you'll have to refer to your own, do have a more specific policy written into it. But if it doesn't, then you can have a separate written distribution policy that says exactly what you're going to do. And that can be changed on an annual basis, typically not changed annually, but it can be without amending the plan. So that tells us, if you're delaying termination for the full 5 years, that you can delay for death, disability, and retirement can only be delayed until the year following the event. And then if you're going to pay installments over a certain threshold, it tells your third party administrator who all would be eligible and the exact amount they're going to be eligible for that year. So it is really beneficial to have. It's not necessarily something that has to be distributed to all participants, but your participants in general should know how you're planning to pay people out. So the SPD is going to also have more general information on that. You may want to communicate something above and beyond that as well.
An additional question that came in, Kristen, that we want to address is commonly when you're talking about repurchase studies, you refer to the haves and have-nots issue. Could you explain for the audience what you mean by that?
Yeah, so you have a group of participants that have a lot of the shares, and then usually your newer participants or people that came in after whatever impact from the initial share releases or whatever it was that don't have very many shares. And that disparity can be caused by different reasons. But that's the have and have not issue that we're talking about, where if you're allocating things on stock account balances, those are going to your longer tenured, usually higher compensation folks that are also closer to retirement age. So you're exacerbating the issue if you use S distributions and you give them more shares that are being purchased with S distributions, and your people that are new and active and have less shares or no shares are getting less or none of that piece of it. So you can create more of a disparity between participants that way. And those are also usually people closer to retirement. So then that increases your near-term repurchase obligations. Ashton, if you can go to the next page, I think that one's you.
Yeah, so with your distribution policy, there's like the method that Kristen just discussed. There's also the timing of distributions. And again, you can't start distributions for death, disability, and retirement later than 1 year following their event. But for terminations, it can be 6 years following the event. In other cases, leveraged ESOPs can further delay distributions until the loan is repaid. Nowadays, that typically is referred to the external loan. So once the company has paid off that external loan, then they can delay the distribution of terminated shares until then. We don't see that as often anymore. I think it was more common back when ESOPs were originally set up, and the internal note and the external notes were the same length. But that has definitely changed over time. So now that internal note is definitely longer than the external note. So most companies, once they have the cash flow available, once they've paid off the external debt, then they can delay, the repurchase. But other companies, their share price is so depressed, they don't even necessarily worry about delaying paying off distributions on the leveraged shares. And you can wait up until 6 years of a termination event to begin distributions. You can also pay them off sooner than that. So there's no need to wait 6 years. You can definitely offer participants a distribution earlier than that. And so you can offer lump sums, you can offer installments. They can be, typically it's 5 installments. They can be extended up to 10 for large balances. So that's looking at over like $1 million balance. There's different wording typically in pre-approved documents where you can extend that up to 10 installments. One additional installment, 1.415 million right there in front of me. One additional installment for every 280,000 over 1.415. So you may encounter that with your ESOP. And then you can also set up lump sum thresholds. So you can say, we want to pay out our smaller balances faster. We don't want to put them into a delay or into installments. You can set a lump sum threshold of like 10,000 or 25,000. Again, it's not like a small amount force out where you're just paying out the distribution. The participant would have to elect that distribution, but you can always offer it to them. You can also set up minimum installments with your installments. So instead of maybe 5 installments on a $50,000 balance, you could say we have a minimum installment of 25,000. So that 50,000 balance would instead be paid out over 2 years versus 5 years. And then again, like Kristen mentioned earlier, the segregation reshuffling that you can put cash into the plan, convert terminated participants into cash. So that way you were moving the benefit to your active participants and not letting your terminated participants that haven't yet elected a distribution sit on that share price growth that your actives are really, working towards growing and actively contributing.
Yeah, and just so the reason we're talking about this, it's an important piece, is this is the primary thing that we would see changed initially if people are looking at alternate scenarios. We're normally looking at some change to the distribution policy or methods. Plan design is another thing that you may be looking to change with your repurchase study results. So looking over what the impact of what a change might do to it. That may be a reason for an alternate scenario, comparing what you have now to the change you're considering making. This is less common, but some of the vesting schedules is probably the least frequent thing that we're looking at, and same with timing of forfeiture reallocations. There could be a reason for a change if you've had a 5-year break in service required before a forfeiture occurs, but you really don't have that high of turnover or rehires. Then it may make sense to get those forfeitures reallocated sooner and into the hands of active participants. So things like that might be a reason to look at a change if you have that, and it may, have made sense at the time, but doesn't anymore. And then with plan entry requirements, there's a bigger push for people for recruiting and retaining with using the ESOP as a tool. And if you're waiting, 2 to 3 years before somebody gets a participant statement and having a hard time getting buy-in from participants, we have seen a shift in either loosening up the plan entry requirements in general or the allocation requirements. There may be other reasons to do that as well, or just using the same year of service to enter the plan, but having a retroactive entry date once they do meet it, so that people could get a statement a year earlier, which could help with some of those issues. Ashton, I think we can go. Yep.
And so the next piece is your funding options for your repurchase obligation. So I would say the most common method is pay as you go. So you just contribute the cash necessary in that year to fund the distributions and repurchase. And typically it just comes from current company cash flow from that year, or you have some reserves that you're able to put into the plan. Some other plans might be using an accumulation strategy, such as a corporate seeking fund or corporate owned life insurance. So that's just where you have kind of a different fund outside of the ESOP within the company's balance sheet that is earmarked for future repurchase needs. And then the last option would be pre-funding the ESOP trust, where maybe you know you have a big repurchase in 3 years, so you start putting in cash now to kind of pre-fund that future repurchase. Maybe you have a really big balance that's retiring. The one caveat to pre-funding the ESOP trust is any cash that you contribute to the plan, it's not going to necessarily stay in the plan. There could be what is called leakage of participants that terminate, and then they can take that cash that you've allocated to them within the ESOP, they can take that cash with them. So it is an option that some plans definitely use, but you may need to put more cash in because there might be some leakage, especially if you have a high turnover rate where a lot of those terminated participants would terminate with that cash. Just something to keep in mind. And then finding the right combination just really is determined on what extent can you handle the annual repurchase out of current cash flow. Is that something that your company can just fund each year based off of current cash flow? And then the other thing to be mindful of is the contribution level. Does that fall within the maximum 25% limitation? So if you do have to fund repurchase in a year, is that repurchase going to exceed the 25% of compensation contribution limit? And if so, then you may have to allocate and contribute like dividends or S distributions to the plan to pass that testing. And in that case, you can contribute more to the haves and have-nots because the dividends, S distributions, they're allocated differently to participants. So they're allocated per share, not on compensation. So some plans really try to stay within the 25% limitation and also not kind of increase that possible haves, have-nots if they have that in their plan. And then what other compliance testing may be impacted? So could you be hitting contribution limits and having to issue refunds, 401k refunds if you have a 401k plan? And then does the benefit level make sense and is it sustainable? So is it sustainable for your company to contribute 25% of compensation in 1 year to fund repurchase? Is that sustainable? That's why we do these studies, so you can better plan for possibly those large years to help better manage your company cash flow and keep the ESOP sustainable. And then your other options, advance funding. Do you need to start a separate fund just to earmark cash for future repurchase? And then is pre-funding the ESOP trust a good use of company cash? So it's really just looking at what options best fit what your goals are for the ESOP as far as what you want to contribute, what you want your benefit to be, and managing the company cash flow to reach those goals.
Hey, Ashton, what kind of insurance would help with cash flow?
I wouldn't say it's necessarily common, but some plans do hold life insurance on participants, with large balances, so that way they can help fund the repurchase needs.
Perfect.
I just saw that question pop up too on the any tax benefit to pre-funding. Not really from the ESOP standpoint. If you're 100% S Corp ESOP, if you were a partial ESOP or C corporation that's looking for those deductions, then there could be more of a reason to pre-fund some additional cash than what you need for that current year's repurchase obligation. But in a 100% S Corp situation, not as much. So some things to consider when you're doing a repurchase obligation for the company. So you want to look at what your current benefit levels are, what they're projected to be over the study period, what you had internally discussed or what you want to get out of your ESOP or what the goals are with that. If you've had compliance testing issues already? If, was it a 1 year issue, or is this an ongoing issue that you need to solve for, so that you can help meet that compliance testing on an annual basis? Or have you done anything to change anything since the plan was set up? I've seen a lot of this, where a lot of our contacts that we had initially when the plans were set up have retired. That task been passed on to their successor, and they don't know anything about why this provisions or selections or policies were made at the time, and or why to change them or when. So making sure that what you're doing and why you're doing it is documented as clearly as possible, and that you're educating and passing that information on to successor people that are taking over or helping with the ESOP. That's really important. And I've seen a lot of issues where, it could be that it was the owner that made all these decisions, and now he's gone, and the successors are like, oh, it looks like they're trying to screw us with this, and look how expensive this is. And so there could be very good reasons for why things were done the way that they were done. They just need communicated. Or on the other hand, you've done the same thing from the beginning, and it made sense at the time, but maybe it is time to make a change, or maybe you're even past that and kind of scrambling to catch up and correct some things. So you want to make sure that you're looking with a study to see when and how often you should be changing what you're doing. And we kind of talked about the goals, but having a separate written distribution policy, I think that's really important if it's not hard coded into your plan, so that everybody knows what you're planning to do and how you're paying people out. And do you even know what you're currently doing? So you do want to understand what the possibilities are, and not just the general information that's in your plan document. So somebody at the company needs to take on that responsibility. Diversification, if that hasn't kicked in, if your plan is under 10 years old, you may want to start thinking about, what are your demographics in your plan? Are you going to have a lot of people that are going to meet that age 55 and 10 years in the plan when diversification first kicks in? And then what kind of workforce do you have? Are they all about trying to get their money as soon as possible because they need to buy a new car or a boat? Or are they more savvy and financial people that know that your stock value is doing really good, and that keeping shares in the ESOP is probably way better than a 401k is performing? So you just want to have an idea of what diversification impacts you might have coming, or are already in the process of. And then, does segregation sound like a great idea? And I always say that because everybody, the first they hear about what segregation is, and they don't want their terminated people reaping the benefits if your stock value is increasing. And so, yeah, it sounds great to get them out of that stock and put them in a cash position, and incent them to take their distributions if they weren't electing them. But it's usually the most expensive option for funding your repurchase obligation. There are caveats to that as well. But if it's basically like paying a lump sum distribution. And so then you're just churning those shares into the hands of other participants sooner, and increasing your repurchase obligation overall, versus just letting those shares sit in one place for that period of time, and paying that one participant a higher value. So it becomes a lot of times more of a philosophical decision than a financial decision. But if your stock value is growing at a faster pace than your turnover rates, then it could make sense financially for you to segregate.
Hey, Kristen,
And
back on the
yeah,
diversification question. Do you have a rule of thumb on how to project how many folks might be actually taking the 25%?
I mean, you can look at your census data to see when people entered the plan and how old they are, and kind of do a projection that way. Or your third party administrator would have a list of who's projected to meet diversification when the first year that it kicks in. In general, the average ESOP has an election rate of 25 to 30% of the shares that are eligible are elected. So we would typically use that for a study that doesn't have any history of diversification.
Perfect. Thank you.
And so if you're up at night, you're responsible for this and you're just worried about how the ESOP's going to be able to afford these, that's likely a time when you want to look at doing a study and looking at some alternative methods, purchase obligations, and the sooner the better. So if you can catch any issues or for projected issues in the future, and know and plan for them ahead of time, that's best case scenario, rather than trying to kind of catch up and correct things if they've kind of spiraled over time and maybe you haven't had a study done. Now's the time to do a study. We do recommend, we may say this at another time, but we recommend every 2 to 3 years. So unless 3 years, unless your assumptions have changed significantly from your last one. But if the banks are requiring it or somebody else, a lot of times we'll see every 2 years for that. So yeah, so the other piece of it is, what does your current allocation look like between, well, it could be between different groups, again, with the kind of have and have not theme, or you could have your a large number of shares held with terminated participants, especially if you did a loan delay. So you're going to have a large number of people that have been waiting to get paid out that are now due, and those are going to be at a higher stock value. So if you can afford to get them paid out sooner, it's probably better to remove that loan delay. But if you have a large number of shares building up in terminated participant accounts, you might want to look at some alternative methods for getting some of those shares moved into the hands of active participants. So that can be done with distribution methods. There's some other alternative methods we won't get into today, but there are tools in the toolbox that you can use to kind of help mitigate some of those issues. You just want to kind of know about them ahead of time before you get in that situation. It is typical for an ESOP, a more mature ESOP, to have close to 30% of the shares held in terminated participant accounts, because there is normally some sort of delay for normal termination, and then you're usually paying installments of some kind over a certain threshold. So there will always be some shares held with terminated participants in most cases. But if you're getting, closer to that 50% or above mark, then that's likely a red flag that you would want to look at. And then just in general, going out 20 years allows you to see those peaks and valleys, or if you have any retirement blips or different, flows in your demographics, based on the age groups of your people currently. So projecting them, at least for your highly compensated people, that are already maybe over or getting close to retirement age, we want to hone in on those a lot closer to see when those specific people may actually retire, so that that's better projected in the timing on the repurchase study. And then last one we just talked about. So that these are, just some of the things that you want to kind of have this list and go through these in your head and discuss internally and with your advisors to make sure that you're understanding what the repurchase study is telling you, and that you're making adjustments where needed, and then documenting the process that you went through and what you're doing to make any changes to the plan or the process that you're doing currently.
So, Kristen, all of those questions help inform whether or not a repurchase obligation study makes sense. Uh, for context, new ESOPs, when should they start considering some of these things and maybe have a study on the horizon?
Yeah, I mean, I would say pre-transaction is really beneficial unless you're a really small company. So before the deal's even done, you want to see what it's projected to look like and when those start to grow, what your benefit levels are projected to be. But otherwise, the first year or two, you're probably fine. You could afford it out of cash flow. Typically, it's just death, disability, and retirement. Most of the time, the other people aren't vested yet. But otherwise, by year 2 or 3, I think you should be looking at it. And it's not that it's, because it's something that you won't be able to afford in the next few years. It's just knowing and planning for the future, when it's coming up, when it's going to grow, and what kind of benefits you're providing. The sooner the better to know and plan for those, makes sense to me. So once you have the results and you've kind of discussed it, with the advisor that prepared the study, and discussed, with management or whoever's helping internally with the study, then a lot of times that's presented at a higher level to the board and possibly the trustee, especially if you're looking to make any changes that the trustee may need to be involved in. We didn't get into it too much, but there is a loan stretch possibility if you're early on in your ESOP loan and your benefit levels and compliance, you have compliance issues projected to be occurring. Then a trustee would need to be involved in that process, or re-leveraging and things like that. And then, we want this documented for, actually taking action from these results if needed, or at least saying, hey, we looked at this, there were no red flags. What we're doing looks like it should be good for the next, 5 years. And then we're going to do an updated study in 3 years and see if it still makes sense. Ashton, if you can move on to the next one.
Yeah, so when reviewing your repurchase study, there's some different ratios that we kind of look at just to see long-term sustainability and kind of see where the ESOP falls compared to average. So the turnover of shares in most ESOPs averages around 7% of total shares. So that's not, it's not going to be for every ESOP, but that's kind of on average what we see. And then, as Kristen previously mentioned, the value to covered payroll ratio determines the repurchase obligations as a percent of covered compensation. This comes into play when you have a high value to compensation ratio. It just means that you're releasing a lot more value of company per compensation dollar. So when those shares come up for repurchase, you could be running into issues with hitting the 25% compensation contribution limit, because those shares are so valuable compared to your company compensation. So that's where we look at, typically plans that have a higher value to comp ratio typically also have a higher benefit level, just because the shares are worth so much in terms of the compensation. And then the annual repurchase obligation to equity value typically averages 5 to 7% for a mature ESOP, which means the shares are being repurchased every 15 to 20 years. And that's what we typically see. You don't really want to be any shorter than that unless you can just really fund it and you have a lot of company cash flow to fund the repurchase every year. But 15 to 20 is kind of what we see on average for a mature ESOP, given that the turnover of shares of most ESOPs averages around 7%. So that's kind of where we get that 15 to 20 year range. A leveraged ESOP is going to be beyond 20 years just because they haven't even allocated all of the shares. So you're not even repurchasing as many shares as you would be once you're fully allocated. And then professional services businesses tend to have a higher ratio, while labor intensive businesses have ratios that are closer to 1-to-1, meaning that professional businesses like IT companies typically have a higher value to comp ratio than maybe like a lumber company that's like more so labor based manufacturing business, where their value to compensation ratios are typically closer to 1-to-1, 2-to-1. And then part of analyzing the RPO study is just reviewing your repurchase obligation, equity value each year. Is the company able to fund the cash flow necessary for the repurchase obligation? So, that's kind of why we recommend doing these studies. Even if you're a younger ESOP, you might not be worried about cash flow, but just to get a handle on what the future years could look like as you allocate more shares, that number can really grow, especially when you reach diversification, and that can be a little bit of a bump in your repurchase in that year. And then looking at the equity value to eligible compensation ratio. So just seeing, does that ratio really fluctuate throughout the study, meaning that your current value to comp, your company value is say 3 times of compensation. Does it grow to like 6 times of compensation, meaning that you're creating a lot more value and really increasing efficiencies and only growing your compensation at half the rate? So that's kind of where we look at, are your assumptions reasonable? Is your company value growing at a similar rate to your compensation? And then the benefit levels. So are they in line with what the company wants? Are you able to fund those benefit levels? Do you want to have participants anticipating 15% of compensation each year? Is that sustainable for the company? So that's one reason we recommend running these studies, just to get an idea of what participants are seeing on average. And if you want to maintain that for the long term, what cash is necessary to keep that running.
And Ashton, I know we're running a little short on time here,
Yeah.
so we did have 2 examples in our slides, and I'm going to quickly just give a little highlight of the first example. We didn't think we would have time to get through the second one, so if you guys download the slides and kind of review them afterward, just let us know if you have any questions on that. But Ashton, if you can just go ahead and skip to those results on the next, yeah, right there. So this company has the assumptions that were put into this in some of these other slides, but this company is providing, if you look at that very last column there, a benefit level, which is the value that the participants are actually receiving. That's pretty excessive. It gets over, almost 105% towards the end of the study there. And they have compliance issues meeting the 25% maximum contribution limits. In most of the years of the study, you can see there the adjusted contribution benefit level. That's including loan payments and repurchase obligation. And so because of that, and they're recycling all the shares, they're needing a lot of S Corp distributions, which we've kind of touched on a couple times today. So the total S distributions needed here well exceeds the actual total contributions they can put into the plan. So this, we talked about some of the averages of ESOPs. A lot of the studies we're working on aren't the average ESOP. Apparently we have a lot of those. So these are kind of the fun things that we like to work on and solve some issues like this. So we looked at some other alternate scenarios versus recycling all the shares because of this reason. So this is just one example of some of the numbers in a real life situation where we need to make some adjustments to what they're currently doing. And with that, we'll kind of open it up for any additional questions. Ashton and I can both be available offline if you want to email us or schedule a call with us if it's more in depth. We're here to help answer any ESOP related questions.
Thank you so much, you guys. And if you are unable to get in touch with Ashton or Kristen, your administrator is a great place to start if you want to start exploring this product. So I don't see any other questions popping up in the chat. I'll wait, a few more seconds. And to all the slides and the recording will be sent out to anyone who registered. So once you get those, you are welcome to explore that and then reach out with questions after you take a second with the slides. So that's all the time we've got. We want to respect everyone's time and get done at the top of the hour. So Thank you so much. If you have more questions, again, please reach out to Kristen, Ashton, or your administrator to get in touch with them. Thank you. Have a great rest of your day.